Introduction. Day trading is exciting. The idea of making money from your laptop, anywhere in the world, is powerful. But here is the truth. Most traders lose. Some blow up their accounts in weeks. A few within days. Why does this happen? It happens because they trade without a plan. They ignore risk. They chase losses. They let emotions control their decisions. And soon, the dream of freedom turns into stress, regret, and an empty account. But it does not have to be that way. The purpose of this audiobook is simple: to show you how today trade without blowing up your account, to give you the mindset, the strategies, and the discipline that separate successful traders from gamblers. This is not about magic indicators or secret strategies. This is about survival, about playing the long game, about protecting your capital, so you can stay in the game long enough to grow. If you are ready to trade smarter, think like a professional, and stop gambling, then let's begin. Chapter 1. The harsh truth about day trading. Day trading attracts thousands of new traders every single day. The dream is always the same: work from home, make money in hours instead of months, live free from the 9-to-5 grind. But here is the truth that most people don't want to hear. Around 90% of traders fail. They don't just fail slowly. Many blow up their accounts in weeks, some in just a handful of trades. Why does this happen? Let's break it down. The first reason is a lack of risk management. New traders see an opportunity and jump in with too much money on the line. One bad trade, and half their account is gone. Another bad trade, and the account is finished. They forget the golden rule: survival is more important than profit. The second reason is trading without a plan. Professionals have a system. They know when to enter. They know when to exit. Amateurs, on the other hand, trade on impulse. They hear a tip on social media. They chase a stock because it is moving. They guess instead of plan. And guessing in the markets is expensive. The third reason is letting emotions take control. Nothing destroys accounts faster than fear and greed. Fear makes you exit too early. Greed makes you hold too long. Fear makes you skip good trades. Greed makes you chase bad ones. One emotional mistake leads to another, and soon the account spirals downward. The fourth reason is overtrading. Many new traders think more trades mean more money. But the opposite is true. The more you trade without discipline, the faster your account drains. The market rewards patience, not constant action. The final reason is a gambler's mindset. Too many traders treat the market like a casino. They want fast wins. They want to double their account in a month. But day trading is not gambling. It is a profession. And those who treat it like a profession survive. Those who treat it like a lottery ticket lose everything. The harsh truth is this: most traders fail because they ignore the basics. They want shortcuts. They want excitement. But trading is not about excitement. It is about discipline. It is about risk. It is about protecting your account above everything else. If you want to succeed, you must be willing to do what 90% of traders refuse to do: slow down, respect risk, follow a plan, control your emotions, and trade like a professional, not a gambler. Remember this: day trading can give you freedom, but only if you protect yourself from the mistakes that destroy most traders. Chapter 2. The Golden Rule of Risk Management. If there is only one rule you follow in trading, let it be this: never risk more than you can afford to lose. It sounds simple, yet most traders ignore it. They put half their account on a single trade. They believe this trade will be the big one. They are certain it will work out. But the market doesn't reward certainty. The market punishes overconfidence. And when that one trade goes wrong, the account is destroyed. Think of a risk management. as your seatbelt. You may not need it every time, but when the crash comes, and it will, it is the only thing that saves you. So how do you actually manage risk? The first step is position sizing. Position sizing means deciding how much of your capital to risk on a single trade. Professional traders rarely risk more than 1 or 2% of their total account per trade. If you have $10,000, that means you risk only $100 to $200 per trade, not more. At first, that may feel small, but this is how professionals survive. They play defense first. They know that protecting their capital is the only way to stay in the game long enough to win. The second step is mastering stop losses. Stop loss is a preset exit point. It is where you decide in advance, if the price moves against me by this much, I am out. Most beginners refuse to use stop losses. They think the market will bounce back. They hope. They pray. But hope is not a strategy. By the time they finally exit, the loss is 10 times bigger than it should have been. With a stop loss, you control the damage. You take a small cut before it turns into a wound that bleeds your account dry. Here is the golden formula. Every trade should have two numbers, the maximum you are willing to lose and the target you are aiming for. If the potential reward is not at least twice the risk, skip the trade. This is called the risk-to-reward ratio, and it is the shield that protects your account. Think about it this way. Even if you're right only 4 times out of 10, you can still grow your account if your winners are bigger than your losers. That is the power of risk management. But remember, risk management is not just about math. It is about psychology. It forces you to accept that losses are part of the game. No one wins every trade, not even the best traders in the world. The difference is that professionals keep their losses small. Amateurs let their losses run. If you want to survive as a trader, make this rule non-negotiable. Never risk more than you can afford to lose. Always size your positions correctly. Always use stop losses. The market rewards the disciplined. It punishes the reckless. Protect your account first, and the profits will follow. Chapter 3. Building a trader's mindset. Trading is not just about charts and indicators. The market can be unpredictable. Prices move in ways you cannot control. That is why the most important tool a trader can have is their mind. A professional trader does not just learn strategies. They learn how to think. They learn how to feel. And they learn how to act under pressure. The first quality you need is patience. The market does not owe you anything. Just because a setup looks perfect does not mean it will trigger. Sometimes, the best trade is no trade at all. Many beginners make the mistake of forcing trades because they are bored or anxious. They think every moment in the market must be action. But patience wins. Waiting for the right opportunity, even if it means sitting on the sidelines, separates the winners from the losers. The second quality is discipline. Discipline is what keeps a trader following their plan. It is what makes them enter and exit trades according to rules, not emotions. Discipline is harder than it sounds. Every day, the market tests you. Every day, you are tempted to ignore your IOSH strategy and chase a sure thing. But discipline is the bridge between your goals and your results. Without it, all your knowledge of risk management and strategy means nothing. The third and most challenging quality is controlling emotions under pressure. Fear and greed are the two most dangerous forces in trading. Fear makes you exit too early. Greed makes you hold too long. Fear makes you avoid opportunities. Greed makes you overtrade. Both destroy accounts. To control emotions, you must develop self-awareness. Know how you react to losses. Know how you react to wins. Learn to breathe, pause, and think before acting. Create routines that keep you grounded. Some traders review charts calmly before the market opens. Others keep a trading journal to release emotional pressure. Whatever method you choose, controlling your mind is not optional. It is survival. Here is the truth. The market is not fair. It will test your patience, discipline, and emotional control every day. And the way you respond determines whether you grow your account or blow it up. A strong trader is not the one who never feels fear or greed. A strong trader is the one who feels them and does not act impulsively. They pause. They follow their rules. They protect their capital. Patience, discipline, and emotional control are not just habits. They are the foundation of your trading career. Build them, and you will survive when others fail. Neglect them, and no strategy will save you. Trade with a calm mind. Trade with a clear plan. Trade like a professional, and the market will reward you for it. Chapter 4. The Power of a Trading Plan. A trading plan is the blueprint for your success. Without it, you're navigating the market blindly. You may make a few lucky trades, but luck is temporary. A plan gives you consistency, control, and confidence. The first part of your plan is defining entry rules. You must know exactly when you will enter a trade. What conditions must be met? What signals are you looking for? The market will tempt you to guess or act impulsively. A clear entry rule keeps you disciplined. You only take trades that meet your criteria. Nothing more, nothing less. The second part is defining exit rules. Knowing when to exit is just as important as knowing when to enter. Exit rules should include your stop loss, of course, but also your target. Decide in advance at what point you will take profits. Do not let hope or fear dictate your exit. Following exit rules ensures that winners are allowed to run and losses are cut before they become catastrophic. A trading plan is not complete without journaling and tracking your performance. Every trade you take should be recorded. The entry, the exit, the reason for taking the trade, and how you felt during it. This simple habit turns experience into knowledge. It allows you to identify patterns in your behavior, strengths in your strategy, and weaknesses that need improvement. Most traders skip this step. They trade, forget, and repeat the same mistakes. Journaling creates accountability. It removes emotions from the equation. It transforms your trades into a learning process, not a guessing game. A good trading plan is personal. It reflects your risk tolerance, your schedule, and your style. It is not about copying someone else's strategy. It is about creating a system that you can follow consistently, even when the market is unpredictable. Remember this: your plan is more powerful than any indicator or tip. It guides your decisions, protects your capital, and builds confidence. Without a plan, you are gambling. With a plan, you are trading like a professional. Trade with a plan. Record your actions. Learn from your mistakes. This is how ordinary traders become consistent, disciplined, and profitable. Chapter 5. Technical Tools that Actually Work. Day trading without the right tools is like trying to drive in the fog without headlights. You need clarity, you need structure, and you need reliable ways to read the market. The first tool every trader should master is charts. Charts are the visual representation of market action. They show you price movement over time. Candlestick charts are especially useful because they reveal patterns of buying and selling pressure. Learning to read charts is essential. It allows you to see where the market has been and anticipate where it may go. The second tool is trends. Markets move in trends more often than not. A trend is simply the general direction of prices over time. Learning to identify trends helps you align your trades with the dominant market force. Trading against the trend is risky. Trading with it gives you a statistical edge. The third tool is volume. Volume shows the number of shares or contracts traded. High volume often confirms a trend or signals a potential reversal. A price move without volume is weak. A price move with strong volume is more likely to sustain. Volume adds context and confidence to your trades. Indicators can also help, but they are not magic. Some indicators are worth your attention. Moving averages help identify trends. Relative Strength Index, or RSI, can show overbought or oversold conditions. MACD can signal momentum shifts. But remember this, indicators are tools, not guarantees. They must be combined with price action and proper risk management. Many beginners make the mistake of overloading charts with too many indicators. They believe more is better. It is not. Too many signals create confusion. Indicators lag. They do not predict the future. The key is simplicity. Choose a few indicators that work for your style. Learn them deeply. Ignore the rest. Here is the secret. The most successful traders do not rely on fancy indicators. They rely on price, trends, and volume first. Indicators are just confirmation. They do not make decisions for you. Master your charts. Understand trends. Watch volume. Use indicators sparingly. These are the technical tools that actually work, and when combined with a strong plan, risk management, and the right mindset, they become powerful weapons in your trading arsenal. Chapter 6. The Psychology of Losses and Wins. Trading is not just numbers and charts. Trading is a mental game. How you respond to wins and losses can make or break your account. Most traders fail, not because of strategy, but because of their psychology. One of the most dangerous traps is revenge trading. This happens when a trader suffers a loss and feels the urge to immediately win it back. They enter the next trade impulsively. They increase their risk. They ignore their rules. And what usually happens? Another loss. The spiral continues until the account is severely damaged. Revenge trading is fueled by emotion, not logic. Professionals avoid it at all costs. Another challenge is handling success. Many traders win a few trades and feel invincible. They start taking bigger risks. They ignore their plan. Greed sets in. Just as losses can destroy an account, unmanaged wins can do the same. The key is balance. Celebrate success, but remain disciplined. Never let wins cloud your judgment. Learning to handle both success and failure requires emotional awareness and control. You must recognize when fear, greed, or frustration is influencing your decisions. Take a step back. Breathe. Stick to your plan. Keep your risk low. Journaling can help. After each trade, write down not only what happened, but how you felt. Over time, you will see patterns. You will learn which emotions lead to mistakes and how to prevent them. Here is the truth. The market does not care about your feelings. It does not reward revenge, arrogance, or panic. It rewards discipline, patience, and consistency. The more you master your emotions, the less the market will control you. Remember this: losses are part of trading. Wins are part of trading. The difference between a successful trader and a failed trader is not the number of losses or wins, but how they respond to them. Control your mind, and you control your account. Chapter 7. Risk-Reward. Ratios that keep you safe. One of the most powerful tools in trading is the risk-reward ratio. It is simple, yet most traders ignore it. Risk-reward determines how much you are willing to lose compared to how much you hope to gain. When used correctly, it stacks the odds in your favor. The most common rule is the 1.2 ratio. This means you risk one unit to make two. For example, if you are willing to risk $100 on a trade, your target should be at least $200. This ensures that even if you're right only half the time, you can still be profitable. It shifts the math in your favor. Many beginners focus only on winning trades. They hope to be right most of the time. But trading is probabilistic. You cannot control every outcome. What you can control is how much you risk and how much you aim to gain. The risk-reward ratio does exactly that. Stacking probabilities in your favor is another key concept. Look for trades where the odds are slightly better than even. Combine this with proper risk-reward. Over time, these small edges add up. Consistency and discipline are more important than hitting big wins occasionally. A common mistake is chasing trades with poor ratios. A trade that promises a huge gain but comes with an enormous risk is tempting. But over time, trades like this destroy accounts. The market does not reward recklessness. It rewards planning and calculated risk. The risk-reward ratio also works hand in hand with your stop-loss and position sizing. Know your loss limit before entering a trade. Set your profit target before entering a trade. If the ratio is not favorable, skip it. Patience in choosing trades is just as important as managing them correctly. Remember this: risk-reward is not a theory. It is a survival tool. Every professional trader uses it, consciously or subconsciously. It allows you to survive losing streaks, manage emotions, and grow your account steadily. Ignore it, and you are gambling. Respect it, and you give yourself a real chance to succeed. Chapter 8. The Art of Cutting Losses Early. One of the hardest lessons in trading is learning to cut losses early. Most traders make the same mistake again and again. They see a trade moving against them and think, it will turn around, just a little longer. That little longer is what destroys accounts. One losing trade can wipe out days, weeks, or even months of careful work. The market does not wait for hope. It does not bend to your wishes. Holding onto a losing position because you are emotionally attached is a fast path to disaster. Professional traders develop a different mindset. They know that losses are part of the game. They accept them, and they accept them quickly. Exiting a trade early does not mean you are weak. It means you are disciplined. It means you are protecting your capital, the most valuable asset you have. Developing the courage to exit fast requires mental preparation. Decide your stop-loss before entering a trade. Stick to it without hesitation. Do not second-guess. Do not hope. This is where discipline beats emotion every single time. It also helps to reframe losses. Instead of seeing them as failures, see them as lessons. Each small loss teaches you about market behavior, your strategy, and your emotional responses. The goal is not to avoid losses entirely. The goal is to keep them small and manageable. Remember this rule: if a trade goes against you and hits your stop-loss, exit immediately. The market will give more opportunities. Protect your capital today so you can trade again tomorrow. The art of cutting losses early is simple in theory, but difficult in practice. It takes practice, courage, and discipline. But once mastered, it becomes one of the most powerful tools a trader can have. Cut losses early. Protect your account. Trade another day. Chapter 9. Protecting your capital. Like a professional. In trading, your most important asset is not your strategy. It is not your indicators. It is your capital. Without it, you cannot trade. Without it, all your knowledge and skill mean nothing. Protecting your capital should always come first. A key principle to understand is that cash is a position. Sometimes, the best trade is no trade at all. Many beginners feel pressure to always be in the market. They believe sitting idle means missing opportunities. The truth is the opposite. Doing nothing can be the smartest decision you make. Holding cash allows you to survive losing streaks, wait for high-probability setups, and avoid emotional mistakes. Knowing when not to trade is just as important as knowing when to trade. Markets are not always favorable. Volatility may be too high. Conditions may not meet your plan. Economic news or unpredictable events can make trading risky. The professional trader steps back, observes, and waits for conditions to align. Patience is not passive. It is strategic. Protecting capital also means respecting risk management rules. Never risk more than a small percentage of your account on any trade. Use stop losses consistently. Avoid revenge trading. Avoid impulsive decisions. Every dollar saved today is a dollar you can grow tomorrow. Remember this: survival comes before profits. Accounts are built over time, not in a single trade. Every professional trader knows that staying in the game is the first step to becoming profitable. Losing trades happen. Bad days happen. But if your capital is safe, you can recover, learn, and grow. Think of your account like a fortress. Defend it. Value cash as much as you value winning trades. Avoid unnecessary risks. Trade smart or don't trade at all. Protect your capital like a professional, and the market will reward your discipline. Chapter 10. Growing steadily, not gambling. Many new traders enter the market looking for a fast win. They want to double their account in a month. They chase excitement. They gamble. And most lose. The truth is simple. Trading is not a get-rich-quick scheme. Trading is a skill, a profession. And like any profession, growth takes time. The first step to steady growth is thinking long-term. Your goal should not be one trade or one day. It should be consistent progress over months and years. Focus on surviving, learning, and improving. Small, steady gains compound into significant results. Impulsive wins and losses are meaningless if they do not fit into a long-term plan. The second step is compounding skills and capital. Every trade is an opportunity to learn. Every mistake is a lesson. By improving your skills consistently, you increase your chances of success. At the same time, growing your account gradually allows you to take larger positions safely without risking too much. Compounding is not just about money. It is about knowledge, discipline, and experience. Avoid the temptation to chase big wins. Avoid the trap of overconfidence after a few successful trades. Professionals think in percentages, probabilities, and long-term outcomes. They build their accounts and their skills steadily, trade by trade, lesson by lesson. Here is the key takeaway. Trading success is measured not by a single trade, but by the ability to stay in the game, grow consistently, and improve over time. Risk management, discipline, emotional control, and a strong plan are all part of compounding your success. Trade smart. Trade with patience. Focus on growth, not gambling. Over time, your efforts will compound, your knowledge will grow, and your Forex account will grow with it. This is the path to long-term success in day trading. Conclusion: you have now learned the principles that keep traders alive in the markets. Risk management, discipline, a trading plan, patience, the courage to take small losses and protect your capital. These are not just rules. They are the foundations of long-term success. The truth is simple. Anyone can take a trade, but only those who respect the market survive. Trading is not about being right every time. It is about managing risk when you are wrong and letting profits grow when you are right. If you remember one thing from this audiobook, let it be this: protect your account at all costs. Because once your capital is gone, the game is over. Trade smart. Trade with discipline. And never forget, your first goal is not to win big, it is to stay in the game.